Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. One event on the docket this week is the annual economic conference at Jackson Hole, Wyoming. Is that going to give us any more clues as to the timeline for Fed taper? I don't know. We're going to try and find out. From our equity strategist, Tracy Reinick, our senior equity strategist, Nick Kalivas, and our ETF strategist, Eric Dutram. Eric, I'm going to come to you first with this whole situation here. Bernanke's not even going to be there this week. He took a pass on this whole event this time around. Is he going to be conspicuous by his absence?
You know, I'm not really too concerned about this whole Jackson Hole thing, and I think maybe it might be a time for Yellen to shine and, trying to make her case to be the next Fed chairman. Mm-hmm. But beyond that, I really think this is a total non-event this year, and that, investors really shouldn't be worried about it. None of the big European central bank governors are going to be there either, and I think investors should just really put this out of their mind.
Tracy, Yellen, you think, is going to get some attention. She might be given some weight in anything she says. Does it really matter at this point whether taper begins in September or December?
Well, if it begins in December, then we have a couple more months of dragging out, what are they going to be doing? So in that way, it actually, I believe, might be helpful if they finally do something in September, because then at least we have some action. We know kind of where they're going. They're going to, tell us more about where they're going. It starts. Everybody's like, it's happening. Then, we get the panic over with, and then we can go on for the rest of the fall. I think it actually does matter.
Market will pick up some direction once it knows what's going on.
Yes, at least once the taper starts, the end of the world hasn't happened, and then we can see kind of what happens. Because, everybody's talking about the taper. Well, what are they going to taper? We don't know yet, but not a lot probably to start out with. So it's not really going to change the equation, but we do want them to be doing something.
Nick, still on the topic of the Fed here. The Fed said last week that for the moment, risk of deflation actually outweighs the risk of inflation. We got inflation numbers in recently. You actually say that while it's consistent with the slow growth environment, there's a lot of pressure on the business sector to assume leadership here, huh?
Yeah, in reference to that question, I think the risk is more disinflation than it is deflation.
Okay.
And I think if you look at what the retailers have been saying, they've been fairly cautious about the second half of the year.
Right.
And so I think what we need for the economy to get on its feet and get going is for businesses to invest and hire and kind of assume more of a role of leadership in the economy.
And you don't see that happening at this point?
I think it's going to be, I think they're going to be very cautious. I think just the events in Washington, the events we're seeing geopolitically in the Middle East, I think businesses have been conservative during the whole recovery period and probably will continue to be so.
Okay. So let's do something we haven't done here in a while, offer investors a little bit of guidance as to what they may do, what they may consider doing to navigate their way through all of this stuff that we talk about here every week. Tracy?
Well, I'm the buy and hold kind of trader person.
Right.
So I always tell people when there's kind of uncertainty out there, even if there's chaos, whatever's going on, you kind of have to ignore all the headlines and just stick with your plan. Use the Zacks rank to find good quality companies, which we've always been doing. Find companies that are growing those earnings and, invest in those and try to not listen to everything else that's going on, because whether or not that there's a taper or there's this or that isn't really going to matter for your longer term strategy.
Nick, you say there's a couple of ways to play here.
Yeah, I think if you're looking to navigate all this volatility, there's three ways really I would do it. One, I would scale back the amount that I invest. If I invest usually $10,000 a position, maybe I only do $5,000 now, so I take less risk that way. The other way would be to maybe look at more dividend-paying stocks, where through the storm, at least you get paid for something while you wait it out. And then if you're more aggressive and you're more of a trader mind, there's a lot of ETFs, inverse ETFs you can use to kind of hedge your position. So if you're comfortable with that type of thing, you can put a short on through one of those ETFs and hedge your portfolio.
Okay. And just, I didn't get you in on the first question. You think that actually there may be more confusion this week as a result of Jackson Hole?
I think you'll see both sides kind of come out with their view. But I do think that the Fed is trying to gracefully exit. And one thing that's gotten a lot of play the last couple of days is this paper from the San Francisco Fed, which basically said QE only added 0.1% to GDP and barely anything to inflation. So I think the Fed is just trying to gracefully exit this I don't want to say an experiment, but kind of this experiment, and you'll probably see that kind of evolve from the symposium.
All right, back to the guidance, investor guidance. Eric, I noticed when Nick was mentioning ETFs, you kind of looked at him like, why are you talking about that? I'm the ETF strategist here.
Exactly. I got to have my territory, right?
That's right. That's right. But you're talking about beta stocks, actually. Watch out for the betas.
The high beta ones I think are a little concerning, and actually to disagree with what Nick was saying about the some of the dividend payers.
See, I knew he had something planned. I could see it.
If you look at the REIT space in particular, these have really been crushed over the past couple weeks. And as the 10-year continues to rise here, I think we could see some more weakness here. So I might want to consider avoiding these for the time being. Instead, I think it might actually be time to start looking at the materials plays. We've seen some strength in gold mining, steel. I know you've been a fan of steel recently. And some of these other ones like oil drilling, I think these might be good plays, along with some of the other emerging technology ones like social media, for example, also been very hot recently. I think these might be a better way to play the market, at least in the short to medium term, especially when we're seeing some concerns with dividends and a lot of the emerging markets out there. I know Indonesia was just crushed this morning, down like 6-7%. That follows India and other major emerging markets that have also seen weakness recently.
All right, thank you all for that. Appreciate you taking the time this time around. They're not going anyplace. They have their top picks for this week, and that's in our next segment.